Perhaps maybe we start with Mr. Fujiyama on my left to give the 5 minutes opening remarks. Thank you.
Okay, good morning. And my name is Hideaki. I'm the CEO of the JAIC Asia Holdings. And the JAIC is the headquarters in Japan, and we are managing about 1 billion across 10 countries. And we used to be owned by the government, but now purely the privately owned. And our focus is the general some sectors, but except for the property. And yeah, basically that's all.
Hi, my name is Peter Hwang. I'm with PineBridge Investments. It was formerly known as AIG Investments. We've been recently reborn as PineBridge, subsequent to the acquisition by a Hong Kong-based tycoon. And since then, we have began operating as normal as possible, as you could imagine. To give a brief background, I'm part of the alternative investment group. Within that, I'm with the private funds group, and we manage about $6 billion in AUM. And since 2000, we have raised 5 series of global fund of funds products. And those account for approximately $2 billion in AUM. Thank you.
Hi, good morning. My name is Choynowska. I'm with Jones Day, one of the international law firms here in Singapore. I'm part of the private equity group, but also do capital markets, M&A, and other general corporate matters. Been here in Singapore for about 6 years, so have seen the ups and the downs in the markets here, and hopefully we'll be able to give some input on the legal aspects of private equity setup during this panel. Thanks.
Hi, my name is Jeff Chi. I'm with Vickers Venture Partners. We manage early stage venture capital fund. We're a pan-Asian fund. Our presence is primarily China, Southeast Asia. Early stage venture is a little interesting for us in Asia, unlike the U.S. Silicon Valley style, where a lot of funding is going towards tech companies. Because of the stage of economic development in the emerging markets, there are actually opportunities in sort of more traditional industries. I can share about that as we go into discussions.
Hi, my name is Praneet Garg. I'm with Asia Alternatives. We are an independent Asia-focused, private equity-focused fund-of-fund platform with about $2 billion under management. We invest across Asia, across private equity asset classes, from venture to growth to buyout. I co-lead our efforts in India and Southeast Asia.
Okay, thank you, Praneet. Basically, the topic is Southeast Asia as a region, and how does it compare with other regions like China and India? In fact, a lot of people have said earlier that Southeast Asia have been overlooked, even if you compare it to Australia, a much smaller country. In terms of GDP, is almost the same with the combined 10 countries of Southeast Asia. But in terms of numbers of the private equity money and investors in general, they are more in Australia in comparison to Southeast Asia. So maybe if I can start the first questions to Jeff on the why is it like that? Why is it has been overlooked? Is it the government regulations, or what is in Southeast Asia that makes it less attractive compared to other regions?
Well, I first of all, I don't think it is less attractive. We are in this market, and I think there are opportunities there, as there are in many other markets. I think the challenge that we have as a fund, and probably the industry as a whole, is Southeast Asia is not one discrete market, one uniform market. It comprises of very discrete components, the largest of which are probably is Indonesia. The other sort of more where we're seeing more activity is sort of Vietnam. So it is challenging in the sense that it is hard there are separate markets, and when you say you're a Southeast Asian fund or a Pan-Asian fund with a Southeast Asian strategy, you really have different strategies for each country. So our approach is a little different. Because we're early stage, we're actually looking for the companies that we invest in Southeast Asia are generally regional plays themselves. We generally don't go after the specific country investments, although there are sort of attractiveness about sort of establishing sort of Indonesian expertise or Vietnamese expertise and investing in those particular markets. We've taken the approach of let's identify what are going to be the successful regional companies that have the ability to transcend the cultural barriers, the language barriers, and the regulatory barriers of these countries. And as a result, the team is more generalist rather than sort of specific country specialists.
Well, thank you, Jeff. Maybe I can solicit remarks from Mr. Fujiyama and probably Peter on why we have not been as prominent as China and India. Have we really under PR ourselves, or we're not doing enough marketing? We're not appearing more in CNN or something like that?
Yeah, actually, I also agree with Jeff, and we also have been in the market for the last 20 years. So because of course we see these opportunities still remain in this market, and but the one of the challenge that we also have been facing for the last 20 years is always some exit, and the IPO market is not so strong as compared to the Japan or maybe Europe or some US. So and also the liquidity also quite one of the issues that we need to address. So meaning that the IPO is not the exit. So we need to find out the after IPO. Still, we need to find out some potential buyers. So this is the maybe as compared to maybe China or India, maybe as you said, less attractive as compared to the other markets.
Peter, maybe.
I agree with Dr. Chi that it's not less attractive, but it is underserved. And if I were to make any kind of comparison, Southeast Asia as a whole is more comparable to, for instance, Southeast Asia, where I think, what's the benefit of looking into a domestic manager servicing one market, for instance, Indonesia, versus getting that exposure through a Pan-Asian fund who has an office in that particular market. Hence, I think the Pan-Asian funds or these regional funds have serviced the institutional LPs in getting exposure in Southeast Asia to date. And I guess I had a brief chat before this panel with Joy, but I think Southeast Asia as a whole hasn't shown enough exits to really demonstrate its return potential. For us as a fund-of-fund manager, we're looking for a market that shows the best risk-adjusted return, not only providing investors with diversification across the region, but we're also seeking markets where we see the best return potential. And Southeast Asia, by far, does have that potential. It's just, how do you go about it? And so far, from our view and our exposure so far has been through Pan-Asian managers versus actually going into a domestic manager.
Yeah, and I think the numbers would suggest that this economies, the 10 nations economy that is part of ASEAN, the Associations for Southeast Asian Nations, has 1.7 trillion combined economies. And if you see the growth number, it's mind-boggling because it grew 7.1% in 2010 and projected to grow between 4.5 to 5.5 this year and next year. So in terms of attractiveness for the economy is still, if you compare to other regions of the world, and the world economy is only growing less than 4%. I'm going to go to the next topic, you talk about the attractiveness. If you remember 97, 98, Asian financial crisis, and Southeast Asia is the one that is hit probably the most, Thailand and Indonesia. Is there any difference post-crisis for Southeast Asia, post-97, 98, and how businesses now being run from there? Maybe if I can, either Joy or Hideaki or Peter.
I'm sort of the new kid on the block, so I've been in Asia since 2007, so I'm not really familiar with the...
Okay, that's 10 years after the Asian financial crisis. How about you, Dr. Chi? You want to add?
I think Southeast Asia sort of learned from the lessons of sort of 97, 98. You know, the key thing there was you know, overinvestment. The debt was available very cheaply, and as a result, the sort of market sort of took advantage of that. And given what's been happening in the U.S. the past few years, I think the global economy has sort of learned that the model isn't necessarily perfect. And that being said, you know, I do see sort of a potential sort of bubbles forming in distinct markets. You know, the real estate prices recently across Asia, currency appreciation, primarily because of a weak dollar strategy that the U.S. has adopted, are sort of potential sort of roadblocks. I would call them sort of potential coming up. But generally speaking, I think, you know, we have learned from the lessons before. I see more sort of managed soft landings rather than the sort of type of crisis that we've seen before. But that's just a personal view.
You want to add,
if I may add, I guess you know, one view is to kind of look at Southeast Asia as a whole, but I think each of the underlying economies probably have had a somewhat different experience post the crisis. You know, and if, for example, if you take Indonesia, obviously it always had the scale and the demographics of it there, but went through a huge, deep crisis, and the way it has emerged from the crisis is somewhat different, for example, from Vietnam versus Malaysia, and so on and so forth. So if you take an Indonesia example, I guess people were really worried about the sovereign risk, you know, after the crisis, and I think given the political stability and the way they have fixed their fiscal balance sheet has proven that, you know, they've taken it the other way around, and they are on track to kind of, you know, stability. Again, the domestic consumption story was always there, but it's only accelerated in the last few years. Another big inflection point was, I guess, the 2009 crisis, and the way Indonesia and some of the other economies also held up in the last crisis have given a renewed confidence to foreign investors to be able to come back to those markets. So I think that's how different economies have behaved differently. Even on the private equity side, I guess, you know, there is now, for example, in different markets, different history of returns, different history of the depth of managers, teams having worked together, having some element of track record, and so on and so forth. So I guess each of the markets have, you know, evolved differently after the crisis.
Well, thank you, Praneet. I'll get back to you on the those characteristics and main challenges, since you also invest in funds. But I want to go to Joy and to talk about what are the key considerations in setting up Southeast Asia Fund, and why it has been very little compared to China, India, even Australia. Not that many Southeast Asia funds.
Thanks. I think key considerations that we look at from the legal standpoint, obviously jurisdiction of the fund and the vehicle structure itself, the jurisdiction of the manager, where the people are, where the investments are, and investors are increasingly concerned with regulatory oversight of the manager. That's becoming important. With respect to fund setup, we still see Cayman and the LPGP structure, and that seems to be what investors are comfortable with, and that's we haven't seen any variation from that. In terms of setting up the manager, increasingly, historically had been offshore, and increasingly investors are seeking more regulatory oversight. So we have seen for Southeast Asian funds a strong interest in Singapore for fund managers. Singapore has been in the midst of implementing new regulations for fund managers, which on the plus side has been a bonus for investors who are looking for that oversight. For the managers, it's harder. The managers with over 250 million Singapore assets under management need to obtain a fund manager's license. If you're under that, it's not particularly burdensome. Another hurdle in Singapore, base capital requirement of 250,000. For serious players, these are not issues and provides investor comfort. So we see that as a positive in the industry. As far as tax incentives, I can't speak in depth about that as a lawyer, but that's also a consideration. Singapore itself has some kinks to work out with respect to private equity tax incentives. The new incentives that have come down over the last year and a half don't take into account the GP-LP structure. So that's been an issue in Singapore. Another issue, funds need to consider where the investors are coming from. If any are from the U.S., have to consider the Dodd-Frank new regulations that are being implemented now. If you're under 25 million assets under management of U.S. money, there's no problem. But if you're going over that threshold, you have to consider registration requirements with the SEC. So those are some key issues we're dealing with clients who are setting up in Southeast Asia.
Have you seen more Southeast Asia funds from your experience in the last year or two compared to 5 years ago, for instance?
I think it's increasingly it's more active in Singapore, definitely, especially with the attention from as far as the regulatory oversight issues, especially after what happened in the U.S. Investors are looking more toward a more regulated environment. Yeah.
Okay, I want to go back to both Peter and Praneet. What are the main reservations that you have investing in Southeast Asia funds, and basically how does it compare with China and India country-focused funds? So maybe with Peter first, and then Praneet.
Sure. Our reservation about, I think I touched on it briefly before, that we're looking for the best risk-adjusted return by market, and we wouldn't particularly diversify our portfolio across all the Asian countries, and so far what we have experienced that we find it suffice to get exposure in Southeast Asia through Pan-Asian managers. But eventually what I would hope to see is the growth in the depth and breadth of the local managers who's able to get over the complexities of covering different Southeast Asian countries and actually presenting a track record that has substantive exit, proof of exit in the market, as opposed to showing a track record that has a very high attractive NAV. But again, I believe that we're not too far off from actually seeing more number of local managers coming to market, and we are seeing growth in number of managers in the region. It's just a matter of whether these fund managers will get over this hurdle in this difficult fundraising environment, where I think Dr. Bashan has touched on it before, that more investors are, they're not prone to take the leap of faith anymore without having a substantial track record. And given that it is still early stage in terms of the development of Southeast Asian managers, that it will be challenging in the beginning, but as long as the managers will stick it out, I think there will be more managers in the market, and then I think we will definitely consider putting money towards the local managers.
Okay, Praneet.
Thanks. At the risk of restating what Peter said, we obviously focus on risk-adjusted return across the Asian markets. We wouldn't just do things for diversification, but also when we look at Southeast Asia, the challenges that have already been discussed by in the previous panels is that we don't see Southeast Asia as one market. It's very difficult to see that as one market, and that has not been borne out, at least in the returns in the previous decade. So therefore, you start looking at each of the individual markets and see where you can meet those risk-return hurdles. And when we start looking at each of those markets, some of them are still very early and small in terms of scale, and then we start to hit the wall on those dimensions. There are fewer of them which are large scale, and then so those are and we look at some of the macro issues then, and some of the smaller economies are still dabbling with some of the macro issues. Private equity specific, as Peter said, we obviously look for track record, team stability, and some of that is now emerging in some of the select geographies in Southeast Asia. And so we don't think it's that much far away where we can see country-focused management